Hello everyone, today is April 19th and this is Wyckoff Trading Course Part 2, the practicum. We have different groups of people. As usual, first class is the open door class. So there are students, there are people who will be signing up, and there are people who are guests. Everybody welcome. For those of you who are students, and especially the ones that are alumni of this class, for whatever number of courses, the practicum you have taken, welcome back. For those of you who are graduates of the WTC one course, the prerequisite to this practicum, welcome to the course. Get ready to start working right off the beginning. From the first week, you will have your homework today for next Tuesday. And then for those of you who are either guests or you guys are considering, should I be taking this class? Well, if you haven't taken WTC1, it's going to be the prerequisite that you will have to go through. But I think the whole idea of today's class, today's show, is just to show you the next step after the WTC1, after the initial flagship course. Where are we taking you next? And the whole idea behind the creation of the practicum was to actually practice in the classroom and to practice outside of the classroom, but to practice in a very, very systematic way. And I'll talk a lot about how I, as a teacher that has taught already thousands of students, about trading, about Wyckoff methodology, how I see the proper way to educate people and how I see this pathway that you should have or any other trader should have. And these are just my thoughts. You might disagree with those, which is totally fine. I'm not insisting on my path. I'm just giving you the best practices that I have found, the shortcuts that I have found. Unfortunately, I'm using this word shortcuts. There are no shortcuts. You just have to put in the hours into this. But I'm going to create some shortcuts for you and our students in order for us to grow faster, in order for us to transition to the next level faster. So this is the next level. If WTC1 was all about the knowledge, accumulation of knowledge, understanding of knowledge, creation of the belief system around trading, around Wyckoff methodology, then practicum is about practicing those beliefs and practicing visual recognition of Wyckoff concepts on any chart, and also the practice of the execution. For those of you who are guests and you are suddenly saying like, okay, well, that sounds like me. I'm that guy. I'm that gal that approaches anything in life, not just trading, in the same way. So Roman's words are resonating with me right now. This is your pathway. This is your education. You are our students. So check out this class. Check out WTC1 from yesterday. It's already on YouTube. And then come to us, ask us questions. What is the best way for me to go about, improvement of my trading? And I'll be happy to answer. Nancy will be happy to answer. But for those of you who already, you know that you want to take this education. So 12 sessions this semester. Summer semester is always short. We're taking a break in July and August from our major offerings, but the rest is still on. So 12 sessions. Alumni, again, we have so many alumni people coming back. So for you, a special rate, payment plan, if this is something that is more comfortable for you. 3 payments, 3 recurring payments. Again, email us at wyckofassociates@gmail.com. Ask Nancy any administrative questions. Ask me any questions related to the course itself in terms of the curriculum or the material. We'll be happy to answer. Next session, April 19th. What's important, but I'm not going to spend a lot of time for WTC1 graduates. You guys are, just transitioning into this next level, next class, so you already know. For the homeworks, 1 file, PowerPoint, PDF, or Word doc format. It's very important. And then don't forget the title in the email, right? So we're receiving a lot of email. The filtering of those becomes kind of like a job. in itself. So we want to know right away, what are you inquiring about, or what are you writing us about? So most definitely put your first name, the initial of your last name, what class this is, and the number for the homework, and set it to our address, wyckofassociates@gmail.com. Uh, Definitely interactive class, but not to the point where each class I'm actually talking to somebody, but there is a lot of interaction in writing in the chat, so be ready for that. And then we will have some presentations, we will have some exercises where I'll volunteer some people, so get ready for that. So therefore a built-in microphone would be nice. And then a very common question, is this session recorded? Yes, it is. Will you be posting it on YouTube? Yes, we will. Tonight, once this video is encoded and everything is ready, you will receive that free video. So if anybody cannot continue for the whole duration of the class, the email will be sent to you with the link if you signed up for this particular session, so no worries. For those of you who are students, or you guys are going to sign up, all recordings and slides, as usual, will be available tonight, slightly after 8 p.m. Pacific. And together with slides, you will have the access to the recording. All right, really quickly, just want to show you this collage, kind of like pretty cool, different products that we're having right now. So let's just quickly go through this. So you are here, Wyckoff Trading Course Part 2. The prerequisite of that is part 1, which is all about knowledge, the analysis. Wednesday classes together with Bruce, Wyckoff Market discussion. 2 weeks ago, we had an open door session. Check this out on our YouTube channel. Pretty amazing analysis of macro situation, of geopolitical events, combined with the Wyckoff analysis of sectors, groups, stocks, futures, sometimes, cryptos here and there. On Monday, very advanced class on chart reading, which we call the tape reading. So we're reading the tape off the chart with William, and these are always ignited by in-depth discussions of what we see on the chart. Highly recommended. On May 3rd, a friend and our colleague, Wyckoffian, Gary Dayton, is going to have a special. Those are 3 sessions, 1.5 hours each. He's going to talk about his book, Trade Mindfully, and it's all going to be related to the psychology of trading, certain behavioral patterns that Gary is going to talk about. And maybe there will be some references to the Wyckoff method, because Gary actively uses, Wyckoff method in his trading. Wyckoff Market Report newsletter. This is just a new reiteration on the old newsletter, but there are such immense improvements where John is scanning, and I'll show you guys a little bit more on this, is scanning based on the Wyckoff structural analysis and creating the list of candidates for the candidates at the sprint position, at the upthrust position, breakout, breakdown, just, pretty significant improvement there. Wyckoff Crypto discussion and Discord is led by Alessio. I'm only there for 30 minutes a week as we both record a weekly session. Pretty lively discussion on anything crypto, and Alessio has become such a big expert of a Wyckoff method application in the crypto world. So check this out. Each Friday, a free complimentary communal Wyckoff watch list that is created by our students, and I curate that on a weekly basis. These are the candidates, and this is a major list. So this is not a small, 20, 30 name list. This is going to be over 100, 150 symbols on that list. But very useful, and our students use this a lot. Bias game you could find on our website, and you could also find that on Twitter. So Twitter is going to be probably the most updated, the most on time type of offering. But in this particular class, what we do with the bias game is we discuss each bias game. I'm gonna show you guys this sequence of analysis. This is extremely important. And probably I should talk about this when we're going to be talking about the curriculum, but this is a huge and big part of this class. Anatomy of the Trade video series on the mistakes and successes of our students with any of the trade. Check this out on our YouTube channel, Franz and John, recording these weekly videos, and also extremely popular. Okay. Ilya is saying, okay, Buy's game inspired me to join WTC1, the amount of time I got it wrong. Yeah, well, this is going to be a slightly different work, Ilya, and we're definitely going to go into a lot of depth of this. Disclaimer, as usual, everything that we discuss here in this classes is for educational purposes only. Stop your recording and read the disclaimer in full. So let's go through the curriculum of the current course. So as I mentioned, 12 session, not 15. The main thing about this course is taking the knowledge from WTC1 and starting practicing and converting it into something real in your trading. I mean, even from WTC1 course, and usually after the second month, students come to us and they say, wow, I see the market in a different way. It just shows in a different way. I just see the structure. I just see how the price structure starts to unfold, and that creates anticipation for the next potential move. And obviously, there are some successes, there are some mistakes. That's understandable because as a student, you are learning. You are not supposed, as a student, to have a consistent success. Otherwise, that would be too easy. So Practicum, WTC2 course, is all about cementing, that skill building and creating that new skill, cementing that skill. And there are two skills in my mind that we are practicing in this class, in this course. First, a skill of visual recognition. What's the use of the knowledge that you have if you cannot apply it, if you cannot see it on the chart? It's useless. As I always tell my students, knowledge is not the skill. And I see a lot of hoarding of knowledge from a lot of traders. People come to us and they say, like, I know this and this and this and this. Okay, well, how come you're not successful? How come you're not consistent? So this is the question that everybody, like in the privacy of the self-talk that you guys are having right now. So imagine like this class, you're having a constant conversation, and that's what I ask students to do. Have a conversation with me as you go through the session. Ask me questions. And if I'm not answering, ask them literally, in the chat room. So when people come and they say, like, I've done this, I've done that, I know this and I know that, my next question is, how's your trading? Are you successful? And people might say, yeah, I'm successful. Okay, well, how consistently you are successful? And then this is where, kind of like problem starts to arise. And definitely, different levels of people, that come to us. But, there is no reason for us to try to market to you something that is not useful. I mean, people come to us only because they realize that what we present to them is a very systematic way of learning a craft. This is the same way how you would learn any craft. Whatever your profession is, 9-to-5 profession right now, how did you do this? You had to go get the knowledge, then you had to go and practice that knowledge, then you had to go into some kind of, apprenticeship and practice under the mentors, and then start working on your own practice. The same here. We're going through the same cycles: the cycle of knowledge, the cycle of skill building, the cycle of process building, and then the cycle of finally mental practices. There is no reason also to come to me and to say, like, well, listen, I'm just so like I'm advanced, but this mental aspect of the trading, that I need to work on. Also, not the correct approach. until you actually mechanize your trading in a very like automated way, where your mind is not questioning your decisions and therefore is not questioning. There is a congruency between your belief system of the market and how you actually trade it. There's no need, for the psychology. If anything, if you are in that position and you think that all of your problems is just because the psychology of trading does not allow you, to succeed in trading, most likely this is a withdrawal. This is kind of like a denial, going away from the potential problems that need to be addressed. And those problems are going to be more mechanical in nature. And, I'm kind of going a little bit with the side note here on the psychology. I just was spending some time today, developing some of the products on that part, of our curriculum. So maybe like, I'm drifting there. So let's just come back to the curriculum of this course. So most important skill for us after the knowledge building is visual recognition. So I'm going to put the chart for you, and then whether this is the homework or in the classroom environment, you have to make your own analysis. Now, here is a trick. The way how I teach is I'm going to first allow you to experience pain. This means that I want you to understand the level of where you are. I'm going to give you the chart. I'm going to say, like, analyze it for me. So you analyze it, you come back, and some of you are going to be good, some of you are going to be, average, some of you are going to be somewhere at the beginning of this analysis. So this truthful identification and awareness of where you are is extremely important for the trader. I think that the most successful traders are the most objective people. They have to see the facts for what they are. So when they look at the chart, they really have to recognize and give the weight to the data that is extremely important, rather than some kind of emotional attachment to the past transference of like, oh, I had this bad trade, so I'm not going to do this right now, even though the probabilities are on your side. So with this, practicing the knowledge through drills and exercises becomes, kind of like a must for a trader. So again, a lot of people that just come for knowledge and then just hoard knowledge, not going to work. And I only say this from my experience as a teacher. I mean, like, as a trader as well. Until you start practicing, nothing will happen in your trading. You still will be inconsistent. You still will go through ups and downs. It's just the amplitude of that might be diminishing, but the pattern is still going to be the same. The trend of this inconsistency is still going to be the same. Our drills and exercises primarily are concentrating on bias and timing. We definitely are going to discuss more of the advanced Wyckoff knowledge, which is going to be in a series of different topics. And it's all nice here. We're going to talk about the phase behaviors. We're going to talk about the volume behaviors, so its variations, the trend behaviors, and so on and so forth. It's all very nice, and it's all very useful. But lately, in the last 5 cycles, we've been developing what I would say probably one of the most important knowledge pieces that we teach in this particular course. It's the sequence of analysis. And basically, the sequence of analysis is suggesting to you to go about analyzing your charts in a specific way. And we have 3 different ways of how we could analyze the chart. I'm not going to go into the details here just because this is an open session, so this is a little bit proprietary. But I'm going to give you the exact steps as to how you should be looking at the chart and how you should be dissecting this chart. Like, where do you start? What observations do you make? What kind of deductions you make from those? And then how do you go about like the whole charts like that? So an extremely important piece of knowledge and skill building. Secondly, we're going to discuss, a little bit over the proprietary material that I've created for myself and for my students. It's called the significant bar analysis. The significant bar analysis is a part of the VSA, volume and spread analysis. So this is where we look at the composition of the swings, composition of the trading ranges, composition of the trends, composition, price structural composition of any type of structures that we see in the marketplace. And with that, as the next step, we're going to also discuss a swing analysis. Now, it's very interesting how this class is truly a collaboration between myself and our students. And I'm extremely proud of that. I'm extremely proud of our students putting me in a position of being uncomfortable about specific questions that are being asked. And usually, during the course, there will be maybe 3 to 5 questions that will produce kind of like a pause in me, I would say. And I would usually come to you guys and I would say, let me think about it. So I'm always looking forward to those questions. So give me those. And that type of mental approach, I think, created this, symbiotic relationship with students where we truly collaborate. So in the last number of cycles, students have been not only advancing the knowledge itself, but also we've started codifying certain things. And I think it's going to bring us somewhere. So for those of you who are into this codification of certain principles, there is a segment in this course that's going to be very, very interesting. All right. Well, with that, let's continue. For those of you who are going like this, no, this is just like the first time that I'm exposed to Wyckoff Analytics, I'm exposed to Ramon, his teachings, and so on and so forth. It sounds interesting. It sounds like me. It sounds like that systematic approach to the education that I need in order for me, to move forward. And I have enough motivation to actually make that step, because sometimes people, would love to go and improve, but that's only a desire. They don't have the motivation to push themselves, to sign up for the class. But for those of you who have that motivation, you got to start at the basics. And in a lot of cases, people come to me and they say I've been taught by this person. I've been reading this book. I've been listening and watching the videos of this particular, person. And we've done this before. I allowed people into the second level, and it was a disaster. It was a complete disaster because people are not on board with the depth of the material that we have at the initial level. And then it becomes kind of like the story of frustration. Frustration for them because they don't understand, the knowledge. They don't have that, grasp of the and depth of that knowledge. And for me, because I have to explain the basics again, so usually those people, we're sending them back to the WTC1, and then as they go through that level, they are just basically saying yeah, that was the correct decision, and I'm happy that I've made that decision. So I really would like you to keep this in mind. The WTC1 curriculum is all about market structural analysis, where we discuss in the price structural environment the changes, right? So from trending to non-trending to trending again, depending on the trends, changes of character, changes of behavior that are being associated with such transitions, and also during the consolidations, Wyckoff events, Wyckoff phases as a timing tool. Then we transition to volume and price analysis. And to me, volume and price analysis, and I absolutely would agree with our colleague Gary Fullett here, it's all about effort versus result. It's all about interaction between volume and price. And there are definitely several variations on that theme, but that's a kind of like a major thing. It's not really about just supply and demand. One of the mistakes from students that I see is over-accentuation of the volume signature, and then undermining, underweighing how we're looking at this interaction between the volume and the price. So we'll talk a lot about that. With that, VSA's bar-by-bar analysis, swing-by-swing analysis, different Wyckoff phases, volume patterns, and so on and so forth. Then we go for a couple of sessions into the relative and comparative analysis. This is something very familiar to you, and I'm sure that a lot of you have a very good foundation on that. But again, foundations could be spotty. You could have some blind spots. So let me give you kind of like a really good understanding of what is the comparative analysis and how is it different from the relative analysis and how to extract value from practicing these two techniques. And then I'll give you, some proprietary things, and we'll talk about filtering and scanning. One session will be devoted to trade management, just because we will be discussing a lot of trade management in the WTC2 course. This will cover entries, exits, stop loss placement, and movement of that, scaling in, scaling out. So, and also the Wyckoff trading plan. So very kind of common, themes on trade management. And the last session, as always, is a Q&A. So for those of you who, again, you just feel like, yeah, this is me. And secondly, I have enough motivation to commit to something like this because it's pretty intense. Sign up for the initial WTC1 course and we'll start there. Might mispronounce the name. Yafal is asking, you teach how to analyze and trade the equity. Do you teach how to screen for those? We're interested in. Yes. So the theme of, or the analysis, the relative and comparative analysis, will include filtering and scanning. And we'll talk about other different products that we have that will aid you in your weekly selection routine. Okay. All right. Today, introductions. We're going through that. Homeworks, market update as usual. So all of our classes have some kind of market update. This is important to us because we need to show our students how we are going about our analysis from week to week. So each class, or almost each class, has that type of portion of the market update. We're going to do exercise number 1 today on observations and deductions. So we're going to go through the bias games, and we'll see, how many bias games could we cover. 134 had 3 slides, 135 had 1 slide, so we'll have to see. And then next class, we'll discuss the article on quantitative versus qualitative practices, which I'm going to give to you today as a homework, and then we'll continue our bias game. We'll discuss the anatomy of the trade homework, which is going to be also a semester paper for you guys, and then we'll do some other exercises. All right, so here's your homework for those of you who are already a student or you guys are thinking about signing up, so take this seriously. First of all, assignment number 1, kind of mandatory but optional. I don't really, one of the things about, our education is that I want everybody to define the level of their commitment. I don't want to really, come and kind of like each class like push you. There should be some ease with which you, commit to the homeworks, or at least an ease of participation and observation. So you could come to the class and you could be an observer, and which is totally fine. Just let me know, like, I don't have time for the homeworks. I'm just gonna consume the knowledge, and that's fine, because to me as a teacher, I think that it's better than not doing anything. So therefore, in whatever shape or form you're gonna take this class, it's up to you. But for those who's going to be doing all of the homeworks, this is your mandatory assignment. So 2 articles out in the outliers. This is the book from Malcolm Gladwell, and I'm sure that a lot of you have read this. 10,000 hours. So we'll talk about the quantification of the practice, and then mundanity of excellence is going to talk about the qualification, if I could say this word, of the practice. What kind of quality and how should we be practicing. So we're going to have 10 to 15 minutes discussion on that. I'm going to present you with some previous students' work on this. It's going to be very educational. It's going to give you a perspective of, how long you might be needing to practice, and then also how you could shorten that time span. Will these links be provided, or shall we Google? Yes, Adam. This all will be in the on the class page. So once the access to that class page has been sent to you, you will be able to access this. Randall saying, at my age, I don't have 1,000 hours. Randall, this is a really good point, and this is something that we will be discussing in the second class. So the discussion here is going to go, how could we go from, let's say, 10,000 hours maybe to maybe 5,000 hours? And how could we create an effective way of educating ourselves and practicing that will accelerate your development as a trader? So kind of like up to you. But if you still think that, okay, well, I'm left with let's say maybe like 20 good years where I will be actively trading. So you have enough hours and enough number of years to achieve certain results, that could be, somewhat life-changing results. Okay, assignment number 2, bias game number 135, 136. I think it's 136, so I'll double check that. The homework will be posted on the class page as well. And then assignment number 3, we will discuss in the next class, so don't worry about that. Okay, let's go and let's talk about the markets. Okay, so here's our market update. So what do you guys think? I mean, what do you think about today's day and today's bar? Write it down, give me some kind of indication. Okay, Randall is saying bullish. Okay, but what's bullish about it? Joe is saying looks bullish, acts bearish. Intent to break out, yet no commitment as a question mark. Simon saying strength. Amelia is saying attempted rally, weak reversal from Armin. Range big from Randall, reversal from Mike. Volume low for this move, bearish from Natalia. Today's bar is analog for March 18th. Probably this reversal right here. Okay. That was from Nick. S&P is still the strongest one from Jean-Francois. Good to have you, Jean-Francois, back. Good range, good volume, maybe a sprint before it from Sanit. Bar closes above local resistance from Ramon. Okay, let's skip that. Okay, close above previous bar and so on and so forth. Okay, so I think that the discussion of this particular bar probably needs to start slightly earlier because we're not just in the best bar that we have seen since the top. I mean, like since this top right here, since we were in the upswing, this is by far the best up bar that we have had. Would you agree with that? Expansion of the spread, right? So all of the up bars right here, expansion of the spread, expansion of the demand, from the previous close, from the previous up bar, and kind of like on par with any other up bars that we're seeing in the downswing. So we've identified the reversal to the downswing on this bar right here. This was the reversal. And now we're having the best up bar, and a couple of things that we need to notice. Well, first of all, we said, okay, the best up bar, that's number one. Secondly, does this bar reverses the downswing? What do you guys think? Okay. When you say yes or no, I want to know why. Because yes or no is very binary. It doesn't contain the information about how you're thinking about this. Retraces more than half of the last big down bar from Eden. No commitment to Iqbal. Iqbal again, binary. Um, Stefan is saying is below the previous 4 bars. Previous down significant bar holding from Joe. Not closing about the less significant bar from Vincent, and so on and so forth. Okay, great. Thinking, right? Thinking, guys. Thinking and writing. This is very important in our discussions in our classes. I don't want you just to be, binary in your replies, yes or no. I want you to start observing and making deductions. So, what is the last significant commitment to the downside? This one right here. This is the major bar that we need to overcome, right? So, but there are definitely attempts to continue this move to the downside. So we have another attempt to break to the downside that concludes as a spring. The price temporarily goes down, tries to commit to the downside, reverses, and then closes above the support. A classic definition of the spring, and we have a small formation right here. So we are currently in a small trading range, a mini trading range that could become a reversal trading range. We have probably couple or maybe even more indications that we might potentially hold here. What are those indications? Well, first of all, and I'm always kind of like a little bit early in identification of the bias, and that actually, somebody might say like, it's a good thing. I wish I would have that. Not necessarily. When you start identifying some kind of emergence of the opposing force, you have to go through still some kind of testing process. And in a lot of cases, a spring event like this could really, take you out. And that's what happened just recently with Bitcoin. I'll tell you more about this in a second. But when we look at this initial movement to the downside, what do we see? We see a really good break to the downside on the increased supply. So definitely bearish. We see the next breakdown, and supply is increasing, and the extent of the breakdown, is sufficient for the continuation. Then we see the next breakdown, and again, supply is relatively high, but it's starting to diminish. So this is kind of like the first sign where we are saying that selling is a little bit exhausted. There is less selling that we would be thinking should be present for this type of the breakdown. And we said that there is still some ease of movement. We need to see the emergence of the demand in order for us to produce some kind of stopping action. So where did this demand actually come from? It's the next bar right here, right? So this is the bar right here where we had an opportunity to go down. There is a limited progress to the downside. There is no immediate break to the downside. And during the day, we have an intraday rally, an attempt to rally that is not successful, but still an ability to rally has some kind of connotation for the presence of the demand. So, and we see from the volume signature increase that demand is present there. And then the next day, which is very important, we are rallying. And how do we rally? When we look at this bar, what are we seeing? This is again, like the best bullish bar at that moment. On that moment, that is the best bullish bar. And it moves on slightly diminishing volume signature, slightly diminishing demand. So ease of movement to the upside. So with this ease of movement, we're kind of sensing, we're feeling that after the conclusion, not the conclusion, but after the supply is diminishing and after the presence of the demand, we have an ease of movement to the upside. How would you, what kind of deduction would you make at this point? Okay, selling is less, demand is present, price stops, and then ease of movement to the upside. So there is somewhat of a bullish background, bullish conditions that are being created, for the advancement. So right here, that was kind of like my call of like, okay, I'm going to pick up something stronger like Russell and do intraday trade with the potential switch to the swing. Maybe a long-term campaign did not work out just because of the next reaction. So what do we see on the next reaction? Well, first of all, supply is diminishing even more. That's number one, so that's good. The attempt to break down does not yield any results to the downside. We do not have even the close. Like here, we have the close, an extension to the downside. Here, there's no even a touch of the support. So pretty good. And then the next bar, we have a spring event. So this is the last test of that weakness of the sell-in that we have, that we were waiting. And then after that, what happens? We need to see, and we're going to study this concept of the synchronicity of the effort and the result. We're seeing how there is somewhat of a slight increase in the upward effort in the demand in particular, and now we are producing the best demand bar. So bullish, 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 bullish. Why are we saying that this is a bearish case? Not only this, this is just local event, right? So this is local structural event. But then when we look at the whole structure, what do we see? Where do we stop? I mean, if we stop here, we're stopping at the high low. And this is very significant. We're also stopping above this bar right here. And to me, this is a very important bar. This is the last time when demand was increasing, somewhat substantially. This is where the institutional buying signature is pretty evident. Like there is no doubt that there's a lot of buying. There is a lot of buying off the bottom, right? So on different bars that we're seeing. So all of that is buying. And then, we are stopping right in at the top of this zone. So from the point of view of the local structural analysis and also more global analysis of the whole structure, our expectation for one of our scenarios, let's say if we're discussing a bullish scenario, was to stop somewhere as a higher low. And the higher we stop, the better, the more bullish case that would make. Then we said that for the bullish case scenario, one of the other things that need to happen for us to confirm, I mean, like the local temporary bullish improvement means nothing if it's going to be negated right away. So let's just say that tomorrow we have a bar like this. So how are we going to think about this area then? There was a temporary bullish kind of condition that is being formed, and it doesn't materialize into some kind of result, and then we're going to continue to the downside. So you always need to keep in mind multiple scenarios, bullish scenarios, bearish scenarios. So for the bullish scenario, what should happen next? Well, we didn't really overcome all of the necessary bars, right? So we just overcame this last attempt to commit to the downside on a significant bar. But we still have this level and we still have this level. And this bar right here is the most important bar in this downswing. So this is what we need to do. We are saying that bullish conditions are here, but we need to have some kind of confirmation. And we have to have more of the cleaner reversal. So just this is on the front of the actual result, upward result. Can we do that? Can we do that tomorrow? Can we do something like this? Can we do, a couple of days of rallying where we are seeing that, demand is actually increasing? Could we have an update tomorrow like this that commits to the upside, and then the volume signature increases and demand increases, and that would tell us a lot about the presence of institutional buying. If that is to happen, there are a couple of things that are going to be extremely important. We are having the reversal, that's number one. We're having the confirmation that now we are in the upswing. And if the demand is increasing, that would suggest that there is some kind of better clarity on all of the geopolitical and inflation-driven events, where maybe the focus is going to be more on, earnings and ability of the earnings, to show some growth. And we are in a weird environment. It's just so weird. It's not like we're not growing. We are, but that growth is very slow. And at the same time, we have a raging inflation. So stagflation comes to mind. And usually that type of period is going to be associated with that, running away inflation, and then the growth that is going to be slowing down or slow growth that could potentially bring us to some kind of recessionary environment, which is our expectation long term, going especially into 2023. But for now, we just have to look at what's happening right now. So these are going to be very, very important things. And then something of the more advanced, thought or an idea. Could we have 2 days or maybe a sequence of days where we have an aggressive demand? Because if we would have an aggressive demand, and let's just say that, well, we already gapping down here. So with that, my expectation for tomorrow's day is probably not going to be something crazy. But could we have something like this? At least. That would probably, be compared to the origination of the upswing somewhere here. It will not be the same, but and there are reasoning for that. It just all relates to the availability of the supply at the support and the resistance level. But could we actually produce something better than like whatever we had in terms of the upward movement in this area right here? And that would start confirming characteristically, because character is extremely important to us, that there is more of the bullish behavior than the bearish behavior. For the bearish scenario, very easy. Just fail here. Just basically, this is your trading range. This is your first leg down. Attempt to go up, fail, consolidate here a little bit more with some weakness, and then do one-to-one, to the support again. So that's it. So we'll still have I would say, like, the judge is still out. I'm not really in a rush to change my bias. We're still showing the bias as a downward bias to be confirmed or to fail. So we're looking for that confirmation of the failure or a continuation. Meanwhile, you would be definitely trading both sides. I have positions to the upside, I have positions to the downside. It's the environment of the trading range that dictates that type of trading, because that's more efficient from the selection point of view. Okay, let's go to other indices. So what do we see today? S&P is definitely pretty strong. NASDAQ cannot overcome the previous resistance, still need to confirm by overcoming it. Anything below that is still bearish, is still continuation to the downside. Russell still there as well, so we need to overcome this resistance. That's why important is going to be tomorrow is going to be extremely important. And the Dow is some of the, on par with S&P, so there is some strength in the Dow. I'm really liking how the Dow actually has the least of the reaction. It's not as dramatic as, let's say, like Russell's reaction or NASDAQ reaction. Russell is obviously the weakest of them all. I'm sorry, the NASDAQ is the weakest of them all. But the Dow is holding, and there are definitely some reasons related to the composition of that index. Okay, let's go to something else. Let's talk about gold. So a question came yesterday to me, and maybe that student is here. Let me just see. Okay, well, doesn't matter. It doesn't matter. So the question was, and I'm just going to say the questions here. Is this rally strong or weak? I don't necessarily see strength. I mean, the strength to me is something like this. This is where it's strong. The current environment, the short-term environment of the structure, is still a trading range. This is where we are. And now there are some problems with this trading range. What are the problems? Well, first of all, when we look at the all-time high, There is no ability of the price to overcome that. And my preference always for the continuation patterns is to have a major sign of strength, what I call this, a major sign of strength over all-time high, and then a major backup action at all-time high. And we just don't see overcoming of this. So in this way, this is a failure. So, okay, so what does this failure lead to? Because this is also very important. It leads to a typical change of behavior reaction, but that is also somewhat aggressive to the downside with the presence of the supply. So therefore, not necessarily an extremely desirable pattern to fail like this and then to have a more aggressive change of behavior like this. But we're still in the upper part of this whole formation. So don't forget that, because this still is somewhat an element of strength. So we might be having like a global strength with this rally of the, the bottom of the range into the upper part. But we have a local, maybe short-term or maybe something more pronounced weakness as we're currently experiencing. So and therefore, from here, you start analyzing the swings, you start analyzing the bars. So what are the swings? 1, 2, 3, 4. Would you say that these rallies are strong? I don't see it this way. I don't see strength here. I see more of kind of like a leg elastic, weaker behavior than we would prefer. So therefore, is this an asset for us right now to consider? Probably not. But coming to the, let's say, miners as the industry group, whether you're taking, the gold miners or just miners or just, specifically silver miners, there are really good candidates right there. You just have to be selective and specific. There are two major trades that, I've been conducting in gold and silver as well. So I have long-term campaign trades, which are usually cash trades, whether it's in my personal account or in my hedge fund account. I'm a co-manager of the hedge fund. And also some personal leverage futures trades. So with cash positions, those are easy. I bought gold in 2019. I'm still in it. Like there is no technical reason for me to get out. I don't see it yet. And we have high objectives for gold. But that's a long term. When this will materialize, that's a question. I mean, like, and you see my mental capacity to stay in the trend for so long, since 2019. Shorter term trends is that you have to identify where conditions are starting to change, where there is a desirable point of entry. So in this case, we have 2 points of entry, and this is all futures. So a leverage position for acceleration of the upswing makes a lot of sense. Our initial target was 1950, so this is initial trim, exit number 1. And then at 2050, I believe, and then slightly below this low right here, exit number, so if this is 1, this is 2, this is 3. So that was the trade. That was a swing trade. The intention of that was a swing trade, and then I thought that the result was pretty good because you have a lot of efficiency with the swing trading like this, where there is acceleration of the price movement, there is a lot of momentum, a lot of velocity. So that was a really good trade. Let's go to oil, just to kind of get rid of the most obvious things first. A trading range as well. We're seeing some kind of maybe like apex that is being formed. Lower highs, so this could be a suggestion of like, could we retest the support with the lower low here and then come back? I don't know, just because phase B, where we are at right now, is highly volatile, and usually we trade that on the intraday to a short-term swing basis, and that would work extremely well here. And I've shown you guys, or together with William, we've shown you some of the trades, especially William, how you should behave in this type of the environment. Let's not go to 10-year yield. Let's go to Bitcoin. So there are quite a few things here, and I'm just going to show you my calls and trades. So they are kind of combined together, right? So a call to the downside, point of entry short. This was a kind of an amazing call, call in for 1 day of what I call a stupid bar, minus 10,000 in 1 day. And then this is a point of entry for long position. This is 1, 2, exit. Just there was no reason for me to stay, even though this was a long-term campaign position, but I was not really comfortable staying in the trend that is being broken. So therefore, this exit right here. Exit entry here, long. Here as well, trim here, and then stop loss exit here. And then there was, just a smaller position that was remaining here. I got in on the intraday trade right here, so this was intraday entry, and it got me out just because it was an intraday trade on the spring, which was kind of unfortunate. So these are just my trades for your records and for my transparency. And just as a rule, you can ask me about any of the trades, as you guys already know about this. I definitely am not hiding anything, and I think it's crucial for any educator in this field to show what you do, not just from the perspective of winning trades, but more importantly, how you lose it. So I wouldn't really say that, I'm showing you definitely a lot of good trades, but for instance, like right here on the screen, I had a break-even trade, and this intraday trade just turned out to be like a small losing trade. And those moments will happen, and we'll discuss this a little bit more in the anatomy of the trade. But for now, what do we see? Upsloping trading range, clearly defined. There's nothing kind of like unusual about that. There is definitely a lot of demand off the bottom. So each time we have the reversal around the bottom, we have some kind of demand coming in, but that demand is diminishing. We also should recognize that supply is diminishing as well. So there is like this hesitation. I think that the key is going to be all about this bar right here. Would we overcome this bar? What would it mean? This would mean a higher low in the global structure. This would mean that on the low demand, we have the capacity to commit to the upside. This would mean that from the downswing, now we are transitioning into the upswing. And there is enough causality for the price, to start advancing up. But if this is a local confirmation, we need to see a more global confirmation. So what would be a global confirmation? Well, we've talked about this. 46,000 was an extremely important level. Why? Because of the initial stop in action here, because of the testing here, because of the breakdown around this area, and because of the failures, 1, 2, 3, and then 4 as well. It's just in the form of the upthrust, but it has failed as well around this area. So overcoming that will be the second point of the confirmation for the bullish scenario. So point of confirmation number 1, point of confirmation number 2, and then the most important area for a long-term campaigner, 52,000. Why? Because of this. This is the most significant bar on this chart right now that I'm showing you. So if we could have that third confirmation, then we are off to the races to the all-time high and the new highs. But that all has to happen, and preferably it has to happen in the exact sequence like this. Just because, if we are failing here, so let's just look at the bearish scenario. We cannot overcome this first confirmation, it fails. Then what's going to happen? We're just going to drift here, and then we're going to continue to the downside. If we're going to break this level where the testing has happened, like there are 4 areas of testing. that we're seeing, which is slightly upsloping, right? So each test is another high low. So if that fails here and here, we are going to go much lower. We're going to go lower than this area. We're going to go to 30 and to 29. And there will be some kind of value right here, especially at 30 or slightly below. And that could be potentially, another point of entry, depending on how the price structure unfolds. But we are where we are. This is what we're dealing with right now. Could we have an ability to overcome and commit above? So far on the intraday, a constructive structure, but I was expecting a little bit better movement today, right? So we need to, on the intraday, to start overcoming this area where the breakdown has happened. So, and we're seeing how the thrust today was not that great, right? So here we have a lot of demand. Whether this is demand on the way down or on the way up, it doesn't really matter. Just a sequence of how demand comes in and influences the structure. But here we're seeing that, yeah, demand is coming in, but what is the result? The result is much less than what we have had before. So we need to hold here in this area, and we need to continue and commit to the upside. That's the only way. There are no other ways for the bulls, that is. Okay, I think that's it. Why don't we do this? There are quite a few questions here. If I'm going to go through all of them, I'm probably going to spend a lot of time. We're already at 4 o'clock. I would rather just go to the material of the class, but let me just entertain maybe a couple of thoughts here. Okay, points of entry, let's skip that. Okay, so Ramon, I probably answered your question here. So 3 different points of confirmation. Jay is asking, what do you think about the decreased volume throughout the trading range? Right, so I've mentioned this a little bit, right? So both supply and demand are going down at the same time. So how do we deal with this analytically? And this type of the scenarios are going to be very, very common, especially in apex formations, right? So you have some kind of triangular formation, and then the volume starts to decrease. So what does it mean? We go into the period of inactivity. Why does this happen? Like, what's behind this inactivity? And by the way, the main 2 questions that usually students come to us with, and the ones that I'm constantly answering, is why? Why do things happen the way that they happen? Why do we have this period of inactivity? Like, why is demand not coming in? Or like, why supply is not pushing the price down? And the second one, what's going to be next? So the first one is definitely much more important, because if we understand the first question, or the answer to the question of why are things happen the way how they happen, we could with more ease answer the second question, what's going to happen next. So why is this period of inactivity? Well, what did the sellers do up to this point? Did they have an opportunity to sell? They probably have, right? So selling into the climax, selling at the resistance, selling again, selling again, selling again. So they are inactive. They are waiting for the resolution of this pattern. What about the buyers? Did they have an opportunity to buy? Most definitely they did. Like myself, I was buying, I was buying, I was buying. And here, if there will be some kind of continuation as a confirmation, I will be buying again. So again, buyers are inactive. Buyers are looking for some kind of resolution. Would it hit my long-term catastrophic stop loss, or would there be some kind of confirmation of the upward movement? And then there are people who are just on the sidelines because they choose not to participate right now when there is a period of uncertainty. And that's what we call a period of inactivity by market participants. This is where the volume signature will go down, and we don't even there yet. I mean, like, we have a relatively average volume signature, but I just wanted to describe the concept here of inactivity. It's somewhat close when we look at the volume signature, right? Demand going down, supply is going down. So once we have some kind of movement, then people will start making bets and making, their commitments either to the upside or to the downside, with their, specific decisions, specific decision making. And the main point about the periods of inactivity is the actual result. So you always have to ask yourself a question. This period of inactivity leads to what kind of the result? Is it creating a more bullish or bearish structure? And so far, it's a little bit confusing on the structure itself. Why? Because the background is still to the downside predominantly. Again, those confirmatory signs at 46 and 52 have not materialized. There was no commitment and ability to hold above those levels, especially 52. So there is kind of like a weight game right there. But from that point of view, we're still in the redistribution to be confirmed or to fail. But there are definitely a lot of local bullish signs and bullish behavior or change of behavior that we're seeing. It's just that what is the result of that bullish behavior? Still no result. So with that, wait. Don't make any sudden moves. If you're in the position, wait for it to resolve. If you're seeing some kind of local confirmation, that would be your first sign to come in and just say, like, okay, I'm gonna take at least a probe position. And then if I have the second confirmation, I'll take more. If I have the third confirmation, I'll take more. Because as a swing trader, your time horizon will be small, right? So you're looking for something like this. So you could trade that on the first confirmation. If you're a long-term campaigner, you could start creating the position by scaling into the position, and that entails less risk rather than coming in and establishing just the full position right away. So wait. The whole key to this is going to be in this area right here, right now. Either continuation to the downside and ability to produce the first confirmation, or first confirmation and then we kind of like creating the sequence of events to the upside. Okay, that's it for our market update. So this is kind of like a regular thing for us. So definitely in the next classes, I'll be entertaining more questions and we'll just go from there. All right, Wyckoff market discussion. I mentioned this class before. So what do we discuss? We apply Wyckoff methodology together with Bruce, who has immense knowledge on just general trading and also Wyckoff method. And also check out his blog on stockcharts.com, which is a book that he's written about Wyckoff method. So absolutely highly recommend that, and one of the prerequisites for our WTC1 students. No worries, Vincent. Yeah, definitely just catch up on the video and that's it. And then, so market analysis and stock selection. And it's not just stock selection. I should probably put here asset selection. So we talk about, futures, we talk about metals, we talk about grains, obviously not each class, but periodically when some opportunities arise and, we see some kind of rotation. So that would be the key. So market analysis and what do we trade? And then some analysis of student charts. Also, there are, every other week we have this segment that comes from Johnny Scan. That's the nickname for our contributor. So John is, as I mentioned before, is creating the weekly edition of the Wyckoff Market Report. What is this report? It's the report on the markets, the segments of the markets, the groups of the market that are improving or deteriorating. So there is a lot of emphasis on the rotation. And then there is a huge emphasis on in this rotation, in this thematical rotation, what kind of events do we have? And John is using scanning on stock charts as the tool to identify the list of stocks that are in specific Wyckoff structural spots. So for instance, some stocks that are going to be in the spring last point of support position, some stocks will be in the upthrust position, backup, or a breakdown. And then from that, you, first of all, have your weekly selection list. That's number one. Secondly, you could identify the breadth of the market from that point of view, which is a very, you know, interesting and useful, valuable idea. So check it out and sign up on our website. Let's talk about now the main issues that we observe in students' analysis. There are two things really that I see where we fail, you know, dramatically. The first one is an ability to make an observation, and I've commented about this in yesterday's class, but you know, I'll go into this example again. Maybe an anecdotal question for you. You're probably sitting right now in some kind of room, right? It might be an office, it might be just a room at home. Maybe you are listening to this session even in the car, you know, just, you know, having a phone in front of you. So could you tell me, if you are, let's say, in your office, how many furniture pieces do you have there? How many books on the shelves do you have? How many any other objects that you have there? What are their colors, shapes, position in terms of where they're located in the room? And maybe like what's their other characteristics like utility usage? All right, so you can imagine how many pieces of information you have there. So we call them the data sets, right? So you might say like, okay, my first data set is that I have like maybe like, you know, 100+ books. They are of different sizes. They are of different, you know, thickness, different number of pages. They are of different color. They are of different maybe languages even. They are positions in different parts of my office. There are different titles. There are different authors. So there are so many data points that you will not be able to tell me about what you actually have. Isn't that amazing? I'm asking you about your stuff, and you will not be able to tell me or answer exactly all of those questions. Why is this happening? Well, for two reasons. First of all, we as humans cannot retain consciously a lot of the information. So we could retain a lot of information unconsciously, and it doesn't come up to us. We have to create some kind of pathway, you know, to that information. And then also just, you know, huge numbers, right? And then the second thing is that our ability to make observations in life in general is very poor. So therefore, when we look at the chart, how do we comprehend the chart? How do we interpret the chart when we look at it? Because the chart is the same of set of data that is coming up for us. Yeah, so a set of data of like, if I'm looking at a bar, how many, you know, how much data could we extract from, let's say, this picture? We could say, okay, we have a low, we have an open, we have a close, we have a high. We have the extension of the spread between the open and the close. We have the extension of the spread between the low and the high. We have the extension of the tails. And this is already secondary data. So if this is like, you know, this is an up bar, high, close, open, low. This is like, let's say, primary data for us. Then we go into the secondary data. So something like this. And then we go into like the third set of data, which is, okay, well, now what about the context of this bar, right? So a bar by itself means something, but it doesn't mean everything. So when we add the context, okay, so what is the previous trend? And obviously what happens afterwards? So that would define the context. And the context is going to have also a number of data sets there that we need to consider. So in a lot of cases, when people come to us, it's just that, a poor observational skills, not because like, oh, you cannot do this. It's just that because in a lot of professions, we are not required, to make a lot of observations. And that's a problem. That's a problem for us because we are visual creatures. Traders, especially technical traders, need to look at the charts, need to look at the specific data sets that are important. So a data set around one bar, a data set about a swing, a data set about the structure, like a trading range or an uptrend or a downtrend, and then a combination of that within contextual interpretation. So we fail there. Our second failure comes from making correct deductions. We definitely in our deductions making the mistake of not systematizing our deductions. So there is no logical algorithm of how we are thinking about our observations. And on the top of that, we are given really like incorrect weight to specific data sets. So something that we've experienced before, where let's say a bar like this to the downside might have some kind of emotional connotation for a trader. Why? Well, because previous downtrend, goes into the some kind of capitulation, expansion of the downward spread, expansion of the volume signature, very much bearish sentiment driven event. Okay, but if we are going to rely on our past, which is what? Which is basically a point of time in time and space where we were necessarily that experienced. We did not have specific knowledge. We did not have specific skill. So we are transferring from the past something that is not necessarily relevant for today. And sometimes when we start, approaching the market from a more objective point of view in terms of the observation, we could say, all right, well, I see that there is a tail here. And then we go into the objective, deducive state. And we are saying, okay, so by our system, what does it mean that we have a tail? That there is some kind of presence of the demand. What does it tell us that in the downtrend, we have an increase of the spread to the downside that has a climactic volume signature? That probably tells us that there is some presence of the demand, because if this is a very large volume signature, we might be having some institutional buying. So therefore, a climactic definition would suggest a selling climax and therefore stop in action. And from that, we might go into the change of behavior. So already we are thinking about the context here. In the downtrend, stop in action, climactic behavior, stop in action, transition into the change of behavior, transition from a downtrend into a trading range. So this sequence of observations, deductions, whether those deductions about just a specific bar or then contextualizing, what this bar means, for the structure, is not put together. And WTC1 and WTC2 courses, as you guys know, is all about that. It's to creating this, a very systematized way of thinking about how we observe and then how we react to that, right? So how we behave in the marketplace. All right, well, here's our first exercise. A very, very kind of like typical first class, first exercise. So we're gonna talk about the data that we're collecting from all of those bars, and we're gonna list them as observations, and then we're gonna make some kind of deductions. So let's play the game. Let's play this exercise. What are the observations about bar number 1? What could you tell? So write it down, whatever you see, and give me data points only. Don't give me deductions for now, right? So let's only observe, and let's observe correctly. Masoud is saying bearish, a lot of supply from Jean-Francois. Okay, so first of all, down day, bearish. Secondly, supply is there, yes. We probably would be thinking, we don't have the references to the previous data, so we probably kind of like it's questionable whether supply is increasing or decreasing. Okay, so then what else? Ease of movement range, expansion to the downside. We probably might conclude just looking at bar number 5 and looking at the volume in bar number 1 that supply is actually going down. So I would actually probably, as the first deduction, would conclude that there is some kind of ease of movement to the downside or selling exhaustion, right? Because if it's not it's one of the biggest downward bars, but it's not the largest volume signature. So it's either exhausting the selling or there is some kind of ease of movement at that point of time. Okay, what else? Lots of movement on low volume, strong bull bar. Okay, so this is not a bull bar. Down, I cannot see the color. John, I'm not sure. I mean, like this is red and green. You should be able to see that. Big spread, close at the bottom, volume at the middle. Okay, Mike? Okay, so yeah, so close at the bottom. Close at, let's just say at the low. Large down spread, so downward spread is increasing. And I would only say this because there are some bars that are down and decreasing. Supply completely dominant over demand, agreed on that, okay. And this would be even more on the deductions at this point. Oh, okay, John, I'm sorry. So the first bar is red, and then it shifts. Second one is green, third one is red, fourth one is green, fifth one is red. So switching the colors there until bar number 6 and 7 that are both green, and then bar number 8 is red. Absorption at the support, at least temporarily. Okay, so I'm gonna put this under deduction here. And I'm gonna put this in it with the question mark, because to me, it's not necessarily the absorption that happens on that particular bar. It's probably more of the seller's exhaustion. Ease of movement to the downside. Okay, great. Okay, so you kind of could see, guys, how we're going about this, right? So we are defining that there is probably diminishing spread for that, diminishing supply, so diminishing selling for that type of spread. The close is still bearish, so it's at the low. So still there is, somewhat of a theme or a dominant theme that is to the downside, whereas the downward spread is increasing. So supply is still in control, but there is one thing that we're observing, and that is that the sellers might be a little bit exhausted, and that comes to us from the diminishing supply signature. Okay, nothing to this, nothing more to that. Okay, what about bar number 2? What do we see there? Bar number 2, increased volume, yes. And then right away, let's make the deduction. What does it mean, increased volume? No, let's make one more. What about the spread? All right, so there should be a follow through to the downside from the previous bar. Do we have that? We have a temporary follow through, right? temporary follow through, which is basically what? An intraday tail. So volume increases. There is an attempt to go down and it fails. So those are the observations. What is the deduction about this? Under which conditions would we fail to advance down? And would we have some kind of tail in the increase in the volume signature? Less result on high volume, correct, from Robert. Demand overcomes supply from John, yes. And demand increasing from Emilia, okay. In the presence of demand, we would fail to go down from Said, yes. Cell exhaustion, Shandu, which we had on bar number 1 already, okay. Absorption of the supply from the Masood, correct. Demand stepped in with high volume, needs test again, okay. So we know our deduction is that demand is present. And therefore, there is some kind of expectation about the testing of bar number 1 that we're going to go and explore more. So more testing for bar number 1. Okay, bar number 3. Here we are probably still thinking, what is the dominant force at bar number 3? Is it up or is it down? And this is very important. What is that dominant force? To the downside, is it supply? Yeah, correct, to the downside. Why? Well, because bar number 1 defines the whole bias for us, with the data set that we have. There is really nothing else for us to think about. It's to the downside. So as we are continuing to go down, what do we see in terms of the downward result? Sell is in demand, but still not enough to retest the low of candle number 1. It seems to be clear that there is some supply at the 50% of candle number 1. No selling pressure, hold above the demand, diminishing result, buyers step in, lack of progress. Okay, yes, all of that. So downward demand is diminishing. We are seeing the diminishing spread to the downside. We are seeing diminishing volume signature and therefore diminishing selling. And this is very important. So no result to the downside on diminishing downward effort into a higher low at point number 3. What is the deduction about this? Is it a bullish behavior or is it a bearish behavior? Yes, exhaustion of sellers. And more of the bullish behavior, which should lead to what? This bullish behavior creates the expectation for what? For a rally, correct. Okay. And that's kind of like, with the deductions, we could have, primary and secondary deductions, right? So exhaustion of sellers is the primary deduction. And that creates a bullish behavior with an expectation of the rally. That's a secondary deduction. So with that, we're expecting the rally. The rally happens. Okay, so how would we describe the rally at bar number 4? Let's collect the data. Let's observe, right? So what is the upward result of this bar? Is the upward spread increasing? Correct, yes. What about the volume signature? Decreasing, right, from the previous upward bar. And therefore, demand is decreasing. All right, so how would we be thinking about the result? For those of you from WTC1, of course. Intention not succeeded. Intention was down, but bias too powerful and drove through the area of the first red bar from Sunit. But Sunit, did they overcome this area of the resistance? That's the main question for bar number 4. Still no. So it's kind of interesting how on the expanding spread and diminishing demand, the character of this bar would be considered what? Definitely bullish. right? We're expanding the upward spread. It's a better bullish behavior. And we're doing this on lesser demand. So therefore, some kind of ease of movement to the upside. But the upward result is still decreasing. Why? Because we couldn't overcome the resistance. So therefore, here under the deductions, we could say we are observing bullish behavior, a bullish character, but no bullish result. What it would be this secondary, so if this is the first, the primary deduction, what would be the secondary deduction from here? Supply is still present, or maybe demand. It's either supply is still present or demand is not as strong, right? So in both cases, if supply is present, but we have a bullish character, what would it mean? If the demand is not as strong, but we still have a bullish character, what would it mean? We need more testing. Okay. All right, and the need for the testing is basically a trading range. So you kind of see already where I'm going with this, right? So each bar defines the Wyckoff story from left to right, and then we are most definitely, are starting to create some kind of picture. We're creating two pictures, or maybe even three. We are creating the picture of the character. So what's the character of the current price action? And then we're creating the picture of the actual result, achievement of that character. Could it overcome specific important levels of resistance of the support? And then thirdly, we are creating a contextual picture as well. When it all comes together, then we could be much, much clearer in terms of where we are with the sequence of this analysis. Okay, bar number 5, let's go a little bit faster. So we are not capable of committing to the upside. It acts on bar number 4, it acts as a failure. Failure is suggestive of what? Suggestive of the reaction. And we go into the reaction. Bar number 5. This is the most important bar on this chart. So we have definitively increase in the volume. So this is suggestion that we have increase in the supply. What does the tail tell us here? What kind of observation would we have there? So definitely some kind of buy, right? So supply increases and demand increasing at the same time. Okay, so what does increase of the supply achieve? Did we commit below of the support of bar number 2? No, we had just a temporary attempt to commit and then return back. So kind of like a sprint situation, right? Sprint event. What else do we have here? What about the close? Is this the lowest close in the structure? No. Not the lowest close. Okay. And yet, this is the largest volume signature on this chart. So largest effort increase. And yet, we still only attempting to commit to the downside, and at the close, we're not even closing as the lowest close. It's almost like there is a force that pushes us down, and yet we can't go down. So on the deduction side, bullish or bearish? Bullish. Supply being observed, expectation of the rally, and so on and so forth. Yes. So in this case, we could say bullish result. And this result could fail. I mean, like, don't misunderstand me. I'm not trying to predict what's going to happen. That's just not what traders do. Traders really are all about following the market. not arguing with the market. And there is no reason to argue, just because the market really does not know about your existence whatsoever, and it doesn't care about you. So don't emotionalize, the market. In a lot of cases, you kind of like your personal reactions to what the market is doing becomes a trigger for your incorrect behaviors in the marketplace. The market doesn't care what we do. The market doesn't see us. All of the conversations about like, oh, the composite man hit my stop loss is just, let me gently put this in some kind of psychological terms. It's an avoidance of responsibility. It's a withdrawal from the truth. It is a withdrawal from not just self-awareness, but self-acceptance. Because the next question that comes from me to a student who says like, oh, okay, well, the composite man just hit my stop loss. The composite man saw where I put the stop loss and it went for it. I could talk about the legacy definition of why that might happen, but usually a psychological definition, and explanation, is better. My next question is always like, what is your size? Like, what is the composite man seeing your stop loss is going after? Are we going after a meaningful amount of money? Because they are managing, like for instance, I'm the hedge fund manager, so I'm managing millions of dollars. It's not in the thousands, it's not in the hundred thousands, millions of dollars, and we are a small fish, really small. Okay, so imagine like a big fish, a money manager who is managing $1 billion or several $billion, or some of the hedge fund managers or some of the financial institutions would be managing trillions of dollars. I mean, think about BlackRock, think about PIMCO, something like that. I mean, like just undeniably huge size. So do you think that they go after you with the 100 shares or 1,000 on the line or 10,000 on the line or even a 100,000 on the line? They would care less. They don't see you. They don't want to, hit your stop loss. That's not their goal. Their goal is very much determined by their performance in absolute and relative terms. And that's it. That's their goal. And if they are good money managers, then their assets under management is going to go up, and they're going to receive more, more commission from that and more profit. That's how it works. So do not give yourself, too much meaning if your stop loss is being hit. Nobody's chasing you. Most likely, again, this is just an incorrect stop loss placement or incorrect analysis, and that's it. That's all what it is. So I ask my students not to go into that discussion because it has no sense whatsoever. Okay, so let's quickly finish this. I don't have space here, but bar number 6. If bar number 5 had some kind of presence of the supply or increase of the supply, initially on the intraday level, we are going down. Is this supply going down or not on the next bar? Do we have more supply on bar number 6 than on bar number 5? Yes. So supply is going down. What about the result at bar number 6? Is the downward result going down or going up? Definitely less, right? More or less, definitely less. So we are trying to, on the intraday basis, to go down, and we can't commit below the low of bar number 5. Bullish or bearish? No follow through to the downside, therefore bullish. If supply is so strong on bar number 5, why is there no follow through, especially in the area of the support? So here's that contextual definition that comes on bar number 6. No follow through, more bullish behavior. Bar number 7. If bar number 6 says to us, okay, there is no follow through to the downside, so this becomes more bullish behavior, and a confirmation of bar number 1 with diminished selling, bar number 2 with the demand coming in, no follow through at 3, bullish behavior at 4, into the failure of bar number 5, which is a failure itself to the downside, no follow through at bar number 6. So 7 is kind of like a confirmatory bar that this bullish behavior still continues. And it happens on slightly diminishing volume signatures. So demand is diminishing, and yet it produces a better spread at 7 than at 6. So we're still in this bullish type of behavior, right? So bar number 8, what happens at bar number 8? In the area, and this is where the context is going to be important, in the area of the resistance that we've tried to overcome multiple times now, we are coming to this area again. Would you say that this is the best attempt here to overcome the resistance from everything that we have seen? Of course, yeah. I mean, from the data that we are given, this is the best bar as a breakout bar, even though it's weak. And into the end of the session, the close is in the middle of the trading range here. Again, this is a contextual observation rather than, like a primary kind of like observation of the specific bar. At some point during the day, we actually had the price going down, and we almost committed below. There was an attempt to commit below the low of bar number 7, and we've recovered all of this, and we've recovered above 1/2 of that spread. Is that bullish or bearish? Sunita is saying looks bearish, X bullish. Yes. So that's the coin phrase that we have for the practicum. Looks bullish, X bearish. Looks bearish, X bullish. There is some supply, but what kind of supply? Lowest supply on bar number 8 produces a favorable close and favorable attempt to to penetrate and to commit above the resistance. Guys, by the way, how's my audio? Nancy is texting me and saying that, she lost an audio. Can you guys hear me? Yeah? Okay, great. Thank you. So with that, with all of that, and let me clean this up. Sell-in is being exhausted. No follow-through on bar number 2. Presence of demand. No follow-through to the downside at bar number 3 on the diminishing supply signature. So still deterioration of sell-in, so bullish. Emergence of the demand, bullish. No follow-through at 3, bullish. Rally at 4, character is bullish, result is bearish, expecting a reaction. Reaction at 5 happens, does not commit below significantly, and rallies back on the largest volume, presence of demand. Character becomes, again, bullish in terms of the presence of the demand, but requires a confirmation. Could the price go up from here, or would it just go through the support? The price at 6 does not go down. There is no follow through to the downside. And then with that, 7 confirms the bullish case, and 8 is showing an ability of the price to poke into the resistance and be above that. And the demand tail is the largest demand tail, suggesting that there is some kind of ease of movements behind the demand. From all of this, what is the final conclusion? Up or down from here? Definitely up. Was it easy this way to figure out the bias? Do you guys see that? I mean, we were talking about collecting the data through the observation and then making specific deductions. But you need to know what to observe. You need to know what to, how to deduce, right? So, and then how to contextualize all of those observations and deductions. So, but there is definitely a sequence of observations and the sequence of the analysis that we would most definitely, go through. And I will present to you, a specific way of how we analyze this. All right. Sunita is saying, how often do you find that expectations are not met on a bar-by-bar analysis? I imagine there is a ratio. I do not have a ratio, Sunit, for that, but I have some thoughts on that. First of all, the market is very unpredictable. And this is one thing that also on the belief system, people just don't get or don't get correctly. If there is a probability, so let's say like there is a 99% probability that we're going to go up from here, and there is only 1% probability that we're going to go down. What kind of trades in it are you going to originate here? Up, long trade, or short trade? Of course, long, right? So just because the probabilities is on your side for the long-term, long trade here. Okay, and then we have a bar like this to the downside. So how would you interpret this bar? Considering the analysis that we have done from 1 to 8. I was right in action, but not the result. I would say that, our observations were correct and our deductions were correct, because our deductions is not about what will happen. Our deductions is about probabilities, what, could happen with higher probability. But even 1%, and this is where people kind of losing this kind of like statistical understanding, even 1% can happen. I mean, seriously, like that's how it works. At 1%, it could happen. Why? Because let's say like in Forex, which is a really great example, some importer exporter or let's say government intervention happens. Do you think that they would care that this was a bullish definition here for all of those bars? They would care less. They would just come in, and if they need to dump their dollars, euros, pounds, they're going to sell it just because they need it for transaction purposes. If the government wants to create some kind of intervention, they're going to do it. And 200 pips later, you're going to be thinking like, well, how did this happen? Wasn't the probabilities in my favor? Yeah, they were in your favor. Your analysis was correct. But market is uncertain. You don't know what's going to happen next minute, next bar, next day. Why? Because somebody might come in and create a geopolitical event that will ruin the whole bullish scenario for you. So then in your head, you start creating kind of like this illusion, an illusion of like, well, maybe this analysis is not correct. Let me go somewhere else and just like find something else. And then you go through the same cycle because this thought is still going to be there in your head. And you're going to be repeating this over and over and over again. So create correct beliefs around your trading. Market is uncertain. It's an uncertainty that we face each time. And that's why it's so hard. It's hard because of two major things, trading and just the market analysis. First one is this whole understanding that anything can happen tomorrow or next second or next minute. It's the environment of uncertainty. Please read the book by Mark Douglas, who passed away, some time ago already. But, he came to Golden Gate. Hank, invited him. So we had a chance, to have a class with him, to communicate with him. He brought the copies, of his draft book, Trading in the Zone. I believe that's the name. That was a really cool meeting. And, his talk was about that. It's just like, you don't know. Trading Zone. Yes, exactly. Stefan, thank you. You don't know. Like, you don't know. Another example of that uncertainty was Ed Sequoia came to Golden Gate, again, by Hank's invitation. And in the class, he brought a pool key. right? So we didn't have like all of the balls there for him and the table, the pool table. But he said, imagine I have this pool table and however many balls are there, like I don't know the exact amount, like what is it, 15, 12, 20. And he's like, I'm going to break it. I'm going to break that triangle of balls. Could you tell me where each ball is going to end up on the table and the ones that are going to like fall down? Now, the smartest one of you are going to say, like, if you give me enough variables and you give me enough computational power, I could actually, figure out, what's the strength, what's the angle, what's the, like the area of where the ball is being hit, what are kind of like the surface of the ball, the surface of the table, conditions, environmental conditions around, the size and so on and so forth. It's all geometry, physics, and, environmental factors. You could do that, but you don't have that type of observation, the power of observation, and you don't have that type of computational power with your head, with your mind. So therefore, uncertainty is definitely an extremely important belief to have about the market. The second very important belief about the market is that, or trading rather, is that we are not fit to trade as species. We are all about survival. We need to hunt and then to keep it. So every time you are in a position that is profitable and you look at the unrealized gains, especially if you're a beginner, intermediate trader, what is the first thought that comes to your mind? Should I close this position? Why? Well, I don't want to lose what I already have. So there is no understanding or awareness that you don't have it. Until you actually close the position and take that profit, you don't have it. It's still out there. So it's a counterintuitive enterprise that we are engaging in. And to restructure the belief system requires time. But majority of the time, it's just that the belief system is not even addressed correctly. And with that, based on that, there are a lot of failures. Okay, so I'm spending a lot of time on just talking. Let's go to this exercise. Okay, same exercise. Now I gave you 8 bars before, right? So 8 bars, 8 price bars, 8 volume bars. What is the primary data here? Up and down, so red and green. So that would be related to the close. High, low, open, close, volume. And then we have secondary observations of the relationships of the expansion of the spread, diminution spread, tails, volume signatures, expansions, and so on and so forth. And then we have kind of like this next level of observations, which is going to be contextualization of our observations. We are in the trading range. We don't know the previous buys, but we creating the buys from the first bar, and we just go from there, points of resistance, points of support. Imagine now this picture. This is your room right now where you're sitting. How many books do you have? What are the titles of those? What are the authors of those books? What are the colors? What are the sizes? What is the thickness? How old are they? Where do they positioned in the room? Are they on the shelf? Are they on the floor? Are they somewhere in the storage? All of this data needs to be collected. So here is the data. Look at that. How many data points do you have here? A lot. And that's the problem. And not only that, like, okay, imagine that you could observe and comprehend all of this data. Now, the second question that I have for you, okay, well, which data has more weight to you? That's the next level of understanding of this. And then the level after that is, how do you actually interpret your observations in the correct way? Because you could still interpret in an incorrect way. You could still put the weight of your deductions on something that catches your eye. I'm going to tell you right now, and I'm going to show you the area that catches the majority of attention of people in this class right now, and if you're watching this video even after the class has happened, I'm gonna guess that this decline right here on this volume signature is the most attractive to your eye and to your mind event. Am I correct or no? Say yes or no. Okay, so everybody's saying yes. Why? Why is this the most significant piece of information where your mind goes there immediately? Volume spike, largest reactions in today's selling climax. Aggressive move down on ultra high volume. Capitulation in some kind of way. Okay, fear, warning, capitulation. Okay, yes. So here is that quick example where you might be thinking like, why are we talking about the psychology? I wish we wouldn't. And that's kind of like another, that idea, the belief that we are not created well for trading. We are created well for preservation. We are not created well for risk taking. As a species, our goal is to survive, multiply, right? By multiplying, we're surviving. And with that, we need to be cautious. If we are not cautious, if there is no fear in us as an emotion, we would be dead because some predators would eat us, some conquerors would conquer us, and so on and so forth. We would just fall off the cliff just because we have no sense of fear. But because we have a sense of fear, we survive. Now, that sense of fear does not allow us to be free. And that's the problem with trading. We have to take risk, but we can. If we think in probabilities, then we can. Then it's not as painful, it's not as fearful, it's not as scary. Okay, so really quickly, what kind of observations are we making here? And I'm gonna kind of lead you into this just because we're already close to 5 o'clock. We're gonna look at the reactions. Reaction number 1, reaction number 2, reaction number 3, reaction number 4, reaction number 5. So let's talk about selling, just because we're looking at the reactions. What do you see? What do you see from 1 to 2 to 3 to 4 to 5 in terms of, let's say, let's look at the effort first. Selling from 1 to 2, what is happening with selling and with the supply? So here and here, diminishing, right? Okay, from 2 to 3, increasing. Okay, so diminishing, increasing. When we talk about diminishing character of the effort, what does it tell us? It tells us that selling is diminishing, and what is our expectation if the selling is diminishing? At least temporarily, what's our expectation? Attempting to rally, Amelia is saying, yes. Next question, what kind of rally do we have? Obviously, result and character. Good rally. There are 2 rallies here. Weak. Okay. So weak. So therefore, we're seeing at 1 some selling, at 2 some selling, attempt to rally and weaker rally. So therefore, continuation as a conclusion. And then from here, you base your trade. The way how you execute the trade, let's say like a point of entry or multiple points of entry for you. You just create it based either on, let's say, methodology itself or just your refinement of that methodology. So either way. Okay, from selling from, let's say, 3 to 4, what do we see next? Decreasing, right? So 4 is the decreasing selling, which again suggests what? Like in case number 2. We have an expectation for what when the selling decreases? For some kind of rally. Okay, good. What kind of rally do we have now? Now, this is very important. Compared to this rally. Better, stronger, you're saying. Okay, interesting. So better rally in terms of the result. What about, so we're observing some kind of change of behavior. And change of behavior is a very interesting thing. It's a conditional thing. It could happen, but it doesn't mean that the result is going to follow right away, right? So what do we see in terms of the actual buying? Okay, well, demand is actually going down. Okay, last reaction. So we're comparing 5 to 4. Is there more selling or less selling? Definitely less. Much more less. Less selling. And we're seeing this in volume signature as well. So this is the lowest supply that we could find on all of the reactions to the downside. Lowest supply. So there are some kind of conditions which we will call character that is being formed. We're also seeing this character from the downward spread, which is decreasing. We're seeing that the commitment to the downside or the extension of that commitment is becoming less and less, right? So we're seeing shortening of the downward thrust. So the downward result is also diminishing. So we're diminishing the quality of selling and we're diminishing the quality of the result. That should create an expectation again for what? For another rally. And then the biggest question of that we could have is what kind of rally? If we were contextualizing, these two events, and we were comparing, these rallies, and we said that, and we could also take this one as well, and I would say this is the range right here. That maybe at like 3 we have this upthrust rally, but this is definitely somewhat better than 1. This rally right here into the end is better than the last rally at point number 3. So the next question is like, would we have a better rally or worse rally than any of the rallies right now? Definitely better, right? So our expectation is that the rally from here might be better than whatever we've seen before. And therefore, again, we could start making some kind of decisions that are trading decisions, right? So for here, let's say like a potential point of entry, if we have a follow through to the upside and we're expecting a better rally, then we want to enter on the local breakout, on the break of the downtrend. And then our expectation, if the rally is better, is that we are probably going to go above this resistance and maybe retest this breakdown point and this upthrust point. And then we will have to see what kind of character we have here. If the character is bullish, then we probably would be thinking slightly overcoming this level, consolidating, and then continuing to the upside. So there is another a potential point of entry for us here. There is another potential point of entry on the way up before this local resistance. So we're starting to create some kind of logic as to how we would trade this analysis, how we would trade these observations and our deductions. And kind of like creating maybe an objective, a long-term objective based on the information that is given to us during the day about this highs. Okay, so kind of like a very logical thing, then we could apply our Wyckoff structural analysis. Okay, a trading range right here looks like a spring test. If we have a really good rally, a sign of strength, backup action, and then continuation, to the high right here, and then trade it. Here we are. Okay, let's see what happens next. Would you say that this rally is a definitive change of behavior? For sure. This is the best rally that we have had, and therefore a definitive change of behavior. What about the reaction? Diminishing supply, we are only retracing, I don't know, like 10%, 15% retracement. And look at how laborious duration of the reaction, is somewhat okay, but laborious move to the downside. So what would it say to us on the diminishing supply signature? No pressure from selling. No selling pressure. And that the conclusion of that is going to be what? Continuation or reversal? Most likely continuation. And again, we're thinking in terms of probabilities. This is the most probable scenario to continue, but we definitely could have those, low probability events where we just fail. Okay. Simon is like, how do you know that the reaction is complete to make the deduction that it's only went down 15%? Well, Simon, I am using the information that is given to me at this point of time. So I am only making observation, which is a factual observation. And I'm obviously guessing that this is 15%. I don't know the exact number, right? But the factual observation of where we are currently is the current retracement is about 15%. So that's how I'm approaching this. Okay, we overcame a very major breakdown. So this was the major point. So what does it also mean? And this means that the price spends time above that breakdown, and that is suggestive that the buyers are willing to be there, above this breakdown level and to still buy. So we're still seeing how the volume spikes in the demand are suggestive that buyers are buying higher at the higher level. So not only a change of behavior, but a double confirmation of the potential continuation. So any type of reversal here is going to be a point of entry at any level. So you could just like buy, as the price goes up. This is what we see next. So what do you think next? I mean, definitely kind of like a major change of behavior. Now I would be thinking that our trading range is this. Sell-in climax, climactic volume signature, climactic decline, automatic rally as the change of behavior. Secondary test in B, secondary test in B, phase C, sprint, test, extremely big major sign of strength, major backing up action on this line right here. So definitely accumulation. And then continuation. So what do we do with our target? Are we holding okay here? Do we have attempts to go down? So think in terms of observations. 1, 2, and 3. 2 is the lower low, 3 is the higher low. Supply is coming in, supply is diminishing, supply is coming in, So on 3, as supply increases, the downward effort to push the price down is increasing. What is the result of the downward action? Amelia is saying less result. Bullish or bearish? Bullish. Inability to push the price down after overcoming. So if the highest closes were here, I mean, we have some closes above that here. We are actually holding around this area. On the last leg down, there is inability with the increased effort to push the price down to create even a lower low. Still bullish. Until we have a firm confirmation where the character changes and where we see some kind of result to the downside, we're still thinking to the upside. And we have our stop losses where we would be thinking, you know, like a swing stop loss, a catastrophic stop loss, where we would be thinking if some uncertainty happens and we are going to go down, then we just going to get out and we're going to take the profit on this trade. That's it. Nothing else. You don't know what's going to happen. I mean, like you're just defining the current conditions, which are suggesting probabilistically that, you know, there's going to be a continuation to the upside. But would that be the case? You don't know. Okay, what happens next? We are continuing to the upside. So, and now the whole structure is here. And that's it. It seems simple. And usually students say, like, when you explain it like this, it is simple. But when I do this, it is not. And to that, I'm going to say 2 things. First of all, I make mistakes. So to me, it is simple, very simple, you know, in terms of how I conduct my analysis, but it doesn't mean that my result always is going to be, you know, positive. But what's going to be important is the development of the correct behaviors and practices in the marketplace. So you need to understand what kind of correct belief system you should have for successful trading, because you do have a belief system about trading and how you trade right now. So you have to examine that. But this is not the topic, you know, for this particular class. You need to make correct observations and then to make correct deductions out of this, and then to execute correctly after that. And if you keep practicing, what is going to happen with your mind is you're going to restructure your mind. And just it takes time. You know, the mind is such a, it seems like flexible thing, but it's also very stubborn because our ego, you know, hijacks us in a lot of cases. It defends us, like, you know, that conversation about the fear of survival. Ego is always in the survival mode. So as I go through the class, and I might be, you know, talking to nobody in general in this particular class, but you guys are having self-talk. You are constantly talking to me as I talk to you. So, and somebody might say like, yeah, I do that. And now suddenly the feeling of some kind of, you know, bad feeling of, you know, inadequacy almost might come to you. And this is so dangerous because it corrodes the confidence. That confidence, you know, that rebuilding of the confidence can only come from your work. You need to work on building up the correct knowledge, correct skills, correct practices, and then repeating them over and over and over again. And I hope that this class, specifically this class, has persuaded you, especially those who are new to our material. I mean, like for those of you who's been with us for at least, you know, 1 semester, you guys know that, you know, this is the main goal. This is the main conversation. This is the main strive for us, to practice toward that goal. Repeat for this repetition of our best practices over and over and over, so that we would start behaving consistently in the way that would be on the higher probability side of trading. And once that happens, your confidence level is going to go up, and you will feel not just confidence, but internal satisfaction that you were able to overcome this enormous difficulty with trading, where you want to be not just successful, but consistently successful. All right, with that, let's go to the next exercise. We have 15 minutes. I mentioned the tape reading lab, so just go check it out. And figure out whether this is for you or not. I would say that this is definitely more for advanced traders rather than for the beginners and intermediate traders. Usually my advice is going to be to take WTC1 at least, and to take WTC2 preferably, and then go to this. Okay. All right, bias game. So this is another way for us to practice, and another way for us to figure out, where we are, what is missing. We'll talk a lot about the sequence of analysis that I'm going to give you guys. So for those of you who are already students, are you guys going to sign up? Stand by. We're going to literally start on this. I believe it's going to be like the third class that we're going to talk about this. You can play the bias game on our website and on our Twitter. Our handle is at Wyckoff Analysis, so check this out. Each Wednesday, there is the new chart to analyze. You can print it, you can analyze it, and then you can vote whether you think it's an accumulation or a distribution. And then on Friday, you will receive a feedback slide from us, a solution slide. It is a very important educational tool when you have a feedback. So we're going to tell you the Wyckoff story that we see, and we are going to label the chart, and I usually, create those with the idea that the main points are going to be highlighted, in the solution. You also could go to our website and start from bias game number 1. So our current game, I believe, is 136 for this week. So you've got quite a lot of bias games, to go through. So check that out. I'm going to skip 134 because it just has 3 slides here. So just go and figure it out. So let's go to 135, and then in the next class, we'll discuss this week's bias game 136. So have you guys done this bias game, by the way? This was from last week. Let me just see. Okay, yeah. Okay, so yes, no. All right, so more yeses than nos. Okay, so that's great. So quite a lot of alumni. Okay, so I'm gonna ask you a very typical question that I ask about the bias game. So what was the biggest challenge with this bias game? Is there anything specific, like one thing, maybe 2 maximum? Ilya is saying phase D. I don't think that there is phase D here, Ilya, right? So it's kind of like a problem. If I would have given you phase D, that probably would be easier in terms of bias definition. And my intention always with the bias games is to create a slide, an assignment, where you have to analyze the conditions that are occurring before the final confirmation. And that's very intentional. I explain this to students in such way. If I would have given you the bias, if I would have given you the price structure with the confirmation of the bias, it would be too easy. What I want to do is I want you to develop the eye and the mind to observe and to deduce the conditions of the bias that are forming throughout the trading range and that are uh, confirmed, let's say, in the same phase D. If you're going to practice this way, in real life, what's going to happen is that as the trading range unfolds, you're going to be able to identify the bias as the trading range unfolds. So then your attention will go only into timing and execution. So you're saving yourself a lot of time, a lot of kind of like emotional effort there. And once the confirmation comes, you don't have to take the trade before it comes. You could take the trade at the point of the confirmation. But then your level of confidence around this trade is going to be so much more. And that's the whole idea behind this practice. Okay, so let's come back. Phase D, Ilya is saying, was not there. So, okay, so not supposed to be there. Defining trading range, maybe, what, is it apex of trading, Iskander? I'm not sure what the VCP action is. Okay, this looks like phase A and B, but with prior background being bullish. Okay, so are we still discussing what's the problem here, right? Okay, change of behavior retraced more than 50%. Okay, apex, less volatility, harder to read. So that's the problem. So Sunit is saying like it has less volatility, so it's harder to read, right? So a period of inactivity associated with the diminished volume signature, therefore diminished supply and diminished demand at the same time. Apex formation. That's a problem. So, but the solution is very easy because I've already given you the solution during the session. Okay, but we're going to go through this analysis from left to right. So the Wyckoff story, as we call it, unfolds from left to right. And I'm going to walk you through this. And then as we've done this with the smaller series of data, let's say, you know, those 8 bars, we're going to do the same here, but the principle is going to be the same. So the first thing that I want you to identify is the background. What is the background going into this trading range, into this apex? Bullish background, an uptrend, correct. Okay, the second thing that I want you to identify under the background is, so this was trend. I want you to identify the character and the result of the change of behavior. Okay, so under the character, we're going to talk about what is the level of the supply, what is the expansion of the downward spread. So what could we say here? Does supply increase? Most definitely. The downward spread increases? Most definitely. So the character of it is definitely has those bearish characteristics. What about the result? What would you say about the result of the change of behavior? Is the result more bullish or more bearish? Bullish only retraces 50%, more than half of the last move up. Result is bullish, creates a higher low. Bullish does not go below the last significant bar. Okay. Yes, we would judge, the result by how this reaction interacts with the previous rally, which is usually going to be a climactic run. So therefore, the retracement into the climactic run is going to be extremely important. I would say this is probably like it retraces minus 61.8%. How about that? A little bit of sarcasm there, right? So as if I know how how much. Uh, yes, I am definitely precise today. So the result of it is bullish. And it's the result that is so important to us. We could recognize that, yes, the character is extremely bearish because it's the largest reaction so far at that point of time. So therefore, um, every other reaction that we're going to have, so let's say like 1, 2, 3, and then 4, we're going to compare it to that most aggressive reaction to the downside. But so far, we are in the uptrend, and the result of the change of behavior is bullish. So therefore, our initial assumption is going to be what? That this is a reaccumulation to be confirmed or to fail. Okay. And then the rest is pretty simple. You just go through the trading range and you concentrate on these two things, to be confirmed or to fail. From reaction number 1 to reaction number 2 to reaction number 3 to reaction number 4, are we increasing the bearish character of the reactions? So I'm going to just say like reactions from 1 to 4. Character. Are we increasing the bearish character? No. Why would we say so? Well, looking at the downward spread on all of the 3 subsequent reactions and looking at the volume signature, what is happening here? Supply is most definitely decreasing. The downward spread is decreasing even more, than before. So therefore, the character of these reactions is more bullish than bearish. Okay, what about the downward result of those reactions from 1 to 4? Are we increasing the downward result or are we decreasing the downward result? Definitely decreasing. So reactions are being interpreted as bullish on the diminished result and on the bullish character. Okay, how about the rallies? So here is our rally number 1, rally number, let's just put it like this, number 2, and rally number 3. This is going to be very confusing because what is happening with the character? Demand is decreasing and the upward spread is decreasing as well. So therefore, we would say that there is a deterioration of demand, right? Or exhaustion of demand. By the way, what would exhaustion of demand usually suggest? Like exhaustion of selling would suggest the rally, so the exhaustion of demand would suggest a reaction. And by the way, what happens with the reactions? They are of all bullish character and diminishing downward result. So here's your answer already, right? But let's go a little bit further. Okay, what about the upward result? It's definitely diminishing. So we have a character which I call, a period of inactivity. This is where there are fewer and fewer market participants that are trading on both sides. And with that, it's very hard for us to determine the bias behind it. I mean, there are more, there is more granular analysis that we could apply here. It's just that we don't have the time, but we will, like when we would be going through the bias game and we would be thinking about the way how we analyze those bias games, we will most definitely go into much more details. And when kind of like giving your surface definitions here, almost like shortcuts to the solutions. So a period of inactivity, market participants are decreasing, and therefore that is being reflected in the volume signature, where both supply and demand are decreasing, and it is being also reflected in the price itself. So we are creating lower highs and higher lows, and we are creating the apex. With that type of definition, we don't have any changes of behavior, that we could see in the apex formation. So we only can rely on what has happened before, the bias. And what is the prior bias? The background is of an uptrend, so therefore bullish. And the change of behavior is showing some capacity not to negate the result of the climactic round. And then everything else is kind of like, inactive on both sides. So therefore, the definition of the prior bias to be confirmed, and we're confirming that, should stand. And here it is. And of course, your most preferred confirmed way, something that Ilya was talking about, is going to be phase D. Now, let me ask you this question, and it's going to be, a trap for you, a mental trap. Would you open the position right here on this bar? Not knowing what's coming next. And then if you're saying yes, then what's the reason to open this position? I mean, like, to say just yes is really nothing to me, because I want the truth of the decision making. Like, why would you be opening a position here? Could you justify to me opening on that particular bar? Why? And a lot of you saying no. Personally, I wouldn't, definitely no. No, we have not broken above the buying resistance climax. I could, but I would prefer a retest, and so on and so forth. So, there are quite a lot of those no in fear of the upthrust, and so on and so forth. Yeah. But there are certain things here that could lead us, to the actual, purchase on that particular bar. It's the understanding how the structure unfolds after the apex, understanding of the structure of the backup action that could come, the duration of that, the extent of the depth of that. Also, the background to the left, which is the uptrend, change of behavior, and actual apex itself, and so on and so forth. Also, you could bring here the definition of the volume increase on the actual breakout, the extension of that breakout above the apex resistance line, which should be here downsloping. I don't know why it's like horizontal here. So it's definitely, there are a lot of things there as a continuation of this analysis that we could talk about. All right, what is the flash card? Okay, so here's the definition of this. This bias game solution in the form of the flashcard, the concept that was developed by our practicum students, so students that are you in this class, while doing their weekly bias game homework. The idea behind the flashcard is the solution to make a few key analytical observations to the point of the correct bias. Now, this will be explained more next week or the week after next, and I'll explain to you how to formulate a flashcard solution. All right, guys, we are at 4:34. Okay, so bias game number 136 will go through. So let me just kind of stop here, showing you the screen, but I'm still here. Okay, here we are. Oh, actually, yeah. So this is your homework assignment. Bias game number 136. Do not look at the solution. All right? Just do yourself a favor. Do not look at the solution. Print it out, analyze it, send it to me, email it to me as the homework. And next week we're going to go through 136 of bias game. And also you have 2 articles to read. Hold on, where is it? Right here. So you have one piece from the outlines and the mundanity of excellence. So those two homeworks, bias game number 136 and this, two pieces to read. Okay, let's see if we have some kind of questions here. And then we'll stop. Okay, should we do whatever bias game will be posted tomorrow on Twitter as well, or is that 136? That's 136, John. Yeah, so please do that. Okay, I can't wait to go through WTC1, WTC2 from Natalia. Yes, looking forward to that. Looking forward to working with you. So in preparation of that, Natalia, please go to our website under the free resources and on the landing pages of WTC1 and 2. Read the requirements of reading before you're going to sign up. But actually, the cycle has just started, so we just had the first classes in both of the courses, so you can sign up now if you want to. There is already a homework for class number 1. You already signed up for the first one. Okay, great. Yeah, I'm looking forward to working with you. From Simon, when we assess the reactions, are we comparing the reaction in reference to the prior rally or comparing reaction to the prior reaction or both? C, both. Okay. Okay, Patrice, I'll see you in WTC 2. Looking forward to continue our work together. Okay, Adam, let's just talk about that probably at another time. Iskander is asking, okay, how can I decide to join rather WTC 1 or WTC 2? You don't have a choice, Iskander. You only have the choice to join WTC 1. As I was explaining prior to this, is that WTC 2 has the prerequisite, WTC 1. And there is nothing that could persuade me in this world that you know the material of WTC 1 to the point that I want you to know it. I've done this before, as I explained. I've allowed people who begged me, to allow them to come to WTC 2, skipping WTC 1. I've done this multiple times, and every time I regretted that decision. I will never do this again. So therefore, you have to take WTC1. It's not a disrespect to the knowledge that you have right now. It's just that 100% I know that you don't know what we teach in WTC1. And that's it. All right, Roger is asking, is WTC alumni rate for WTC2 students only? So if you have taken WTC2 already and you're an alumni of this class, you can sign up at the alumni rate at 650. If you're just an alumni of WTC1, then you're just gonna use the regular rate. From Randall, I got into WTC1 late and I'm still doing my homework on my own. Should I do WTC2 now and wait? I'd like, if I could do this on my own when I get done with WTC1. Randall, it depends. I mean, if you're kind of like, independent in terms of like, you're not looking at the Twitter for the bias game solutions, that's going to be a big part of our week-to-week work, then that's fine. I would still probably suggest live sessions. They are just, I think, more attractive. You get the market update like, week to week, so it's fresh. You get the bias game discussion, which is also fresh. But if you don't have this opportunity, to take a live class or take a live class and just watch it on demand, if you're in a different time zone, it's totally fine if you want to go for on demand. It's just going to be a different cycle. But you could contact Nancy and you could say like, could I buy WTC2, which is current, and I'm just going to like be behind a little bit. Totally fine. I mean, we are trying to accommodate different situations of people. I mean, like majority of you, as myself, have 9-to-5 jobs. So my 9-to-5 job is to run a business, and all of you have families. So it's all understandable, and you should be able to define that level of commitment, as I said, either at the level of observation or low participation, or more active participation where you could tell me like, push me, and if you could tell me, push me, I'm going to be paying more attention to you. And I'm going to be kind of like almost demanding you to make sure that you're doing your homeworks. And I will be most definitely pointing to certain mistakes that are crucial mistakes right now, whether it's going to be in the classroom environment or via email here and there. So it's up to you. All right. Anything else before we close off this class? I thought that was a good session. I felt kind of inspired by all of these questions and interactions, so thank you so much. And if there are no other questions or no other remarks, okay, one more question from Adam. Have you reviewed the WTC 1 week 15 last homework yet? No, I did not, Adam, and usually that comes in the second class of the WTC2. Just, I wouldn't go through the homework here. So yeah, thank you for the reminder. We could definitely do this week number 2, week number 3, and we'll do that. Okay, with that, guys, thank you so much. It was a lot of fun. Looking forward to seeing you in our classes. Looking forward to our discussions of the markets, of the Wyckoff method, of the analysis of the discussion about ourselves, how we are behaving, in the marketplace. So all of that is most definitely of a lot of interest to me, and I always feel, and I know this in my heart, that my progress as a teacher is highly correlated to the progress of my students. So therefore, with that, bring your best questions, bring your best discussions, bring your best ideas. I want to hear all of that, and we'll go from there. With that, thank you so much, and I'll see you next Tuesday. Bye-bye.